So recently I was asked how I was intending to continue investing in property over the next 6 to 12 months with a potential recession looming and the economy starting to downturn. YouTube, welcome back to another video. Thanks for tuning in, and today I'm running a Q&A. As mentioned in my last video, you can follow me here on Instagram, and I run a Q&A every week or every other week in which I collate the questions from that and also the questions that you ask in the comments box here, and I bring them over to my next Q&A video. And one of those questions was, how do I plan to continue investing over the next 6 to 12 months? And for me, that answer is simple. And it goes back to one of the most cliche property quotes that there are. And that is time in the market versus trying to time the market. And effectively that quote means that long-term wealth in property is built by investing at all times over a long period of time, instead of trying to time the market and being caught out by an up or a downtrend within the market. I actually recently mentioned in a video that a lot of new investors get caught up with the idea of a downturn in the market, and they think it's fantastic because the market's going to go down, I'm going to be able to finally buy cheaper properties, I can get in at the perfect opportunity. But what they often forget is when a market does downturn, that the lenders, the mortgage lenders, start to remove their products. They start to de-risk their portfolio and future investments by removing products, increasing interest rates, and also asking investors to put a higher deposit in. And all of these things are done in order to de-risk themselves and make sure that they can make it through a potential downturn or economic crisis. And in fact, knowing all of that information now and having been someone myself in the past where I tried to time the market, in fact, I tried to take 6 months off of investing because I thought the market would downturn and I thought I'd be able to capitalize on that. I now know that is potentially the wrong strategy. We never know when the bottom of the market is going to be. We never know exactly when the top of the market is going to be. So trying to time that is incredibly difficult. And in fact, what you're better to do is always try and invest in property and always be on the lookout for a good deal. We make our money when we purchase at the right price and we hold that investment over long periods of time rather than trying to buy it at the right time. Now, next question that's come in is, why do you always purchase cheap houses? And I think there's a bit of a dig, but equally, I don't take it as a dig because when I started out, I had low funds. I had a low amount of money to work with, a low amount of savings, and I needed to try and invest that to the best of my ability to try and achieve the best return on investment without purchasing in a very, very, very risky area. Now, I managed to kind of find a balance between the three of those, and I'm still very glad with my initial buy-to-let purchase. I still hold that to this day, still have the same tenants in that property to this day, and that is one of my favourite investments. Although you shouldn't have favourites, that is one of my favourite investments, probably because it was the first one. But surely now that you are a more experienced investor, Justin, now that you've bought buy-to-lets number 3, number 4, now that you've got more cash coming in from the business, now that I've got more access to more investors, perhaps more access to more private investor finance, surely I would be buying at a higher price point. And whilst that is true, whilst I am looking to buy bigger houses, not necessarily just small 2-beds now, looking at larger 2-beds, looking at 3-bed properties, terraced, semi-detached houses, I go where the deal is. I look for properties that are well priced, good opportunities, and they're the ones I buy, no matter whether they are a 3-bed or whether they are a 2-bed. So the one where you've just seen me purchase just under 2 months ago for £54,000, at the time of buying that house in that condition, there were similar properties in similar conditions at £75,000 and £80,000 on the road, with the done up values being £95,000 to £100,000. So where most people are going out and paying £75,000 or £80,000, I have secured that at £54,000 due to the level of works and due to finding a good off-market opportunity. So I'm not just buying cheap houses, I'm buying good deals, good opportunities, adding the value still, and then either refinancing or selling. So I don't just buy cheap houses, but I buy into good opportunities. And when I'm doing direct to vendor for my sourcing clients, whether it's for them, whether it's for me, I'm just looking for what is a good area to invest in, where do the numbers work, and what opportunity can I secure? So next question is, what can a beginner property investor do to find good property deals? Well, first of all, I would say this Thursday, the 24th of August, join me on YouTube at 7 p.m. for a live stream in which I'm going to be sharing some ways in which you can find good property deals, but also teaching you about how you can start sourcing. So this Thursday at 7 p.m, join me on there. Be about an hour worth of free information and a Q&A at the end. So I'll see you there. But going back to the question, what can a beginner property investor do to find good deals? My personal opinion on this is that people try and overcomplicate it too quickly. Beginner investors need to just get good at the basics. And the basics for me when it comes to property investing, finding a buy to let, whether that be a turnkey or a buy, refurbish, refinance type of deal, is, booking viewings, doing trips to the area that you're investing in, and obviously talking to agents, making offers, just getting the feedback from that. Because if you're making good and low offers and trying to get and secure deals, you're probably going to get rejected. You're probably going to build relationships with estate agents. You'll probably get feedback from those trips, those viewings, those offers. So for me, rather than sitting behind a computer all the time, it's right, I now know what my strategy is. I know where I'm going to invest. I know how to analyze a deal. Now I'm going to get out there and do it. And the more you do that, the more you will get comfortable with that uncomfortable feeling which comes from booking a trip, doing the viewings, making the offers. From there, if you have no luck, then you can start to explore other options. But I think a lot of beginners overcomplicate it. And the other option being just work with a sourcer. If you really don't have the time, if you really don't have the hunger or the want to go and find the investment, sign up to several different sources, see what they have to offer, see what kind of deals they send through. And again, just practice analyzing those deals as they come out to you, as they get sent, picture yourself buying them. And then when more deals come out in the future, then you're ready to click your fingers, off I go, I'm going to buy that, I'm going to invest in that. I've seen plenty of deals before. I now know what a good deal looks like. And for this next question, I'm giving away a bit of a kitchen exclusive here, a bit of a sneak preview. And I am working on that video for the channel at the moment. We are in the depths of going through all the footage that I got, editing it, and that video will be on the channel very soon. But for this next question, it is 2 or 5 year fixed interest rate. Which mortgage should I go for right now? So this question is basically asking, if we're going out and getting a mortgage on a buy-to-let tomorrow, whether it's interest only or repayment, should we do a 2-year or should we do a 5-year fixed mortgage? Now, as you can imagine, your overall length of mortgage, your term might be 25 or 30 years as the time span, but we're actually choosing a product here. So we're looking at a 2-year product, a 5-year product. You might even look at a 10-year product. There are some of them out there, although not many available. But in most cases, if you are an investor and you are looking to refinance right now, or you're looking to secure a new property, a new turnkey, ready to go buy to let, we'll be looking at probably getting a 2-year fixed mortgage or a 5-year fixed mortgage. Now, what would I do in this instance? Well, things are becoming slightly more uncertain, although I don't think we've really seen a huge change to the demand for buy to let properties. It does seem as if the waters are changing, the economy may change over the next 12 to 24 months. Certainly the uncertainty within investors is starting to creep in. And therefore we need to start thinking about, being safe when it comes to getting mortgages, trying to de-risk things as much as possible. So right now you might be able to go out and get a better 2-year fixed rate than you might be able to with a 5-year fixed deal. But the issue being that we are hedging against what is the market going to do? What are the interest rates going to do? Because we could get a 2-year fixed mortgage product, and then in 2 years from now, when we need to refinance, the interest rates might have risen, meaning that would badly impact the cash flow of our property. Versus if we go out and we get a 5-year fixed rate, we might pay more for that 5-year fixed rate because we are locking in a deal for longer now. However, the chances are we are paying more now, but we are taking an element of the risk out of this investment. We are taking away some of the stress that might come from refinancing in 2 years' time by being able to take out a 5-year product. Now, that's not to say at the end of those 5 years, the interest rates might still be high, or they might have risen even higher. But that is something that we have to account for as property investors. When looking at investments, we need to be stress testing. Because even a year ago, when we could quite easily get a 3% limited company mortgage, now we're looking at 4%, 4.5%, 4.6%. And in a couple of years from now, we might be looking at 5%, 6%. Times have even gone higher than that. So if at the time of buying that property, we can stress test it at 4%, 6%, 8%, to see if it still cash flows at those different levels, then we can predict the future and we can take the stress out of it, we can take the risk out of it, because we know, okay, if we refinance in 5 years' time and we are going to be paying 6%, well, that's fine because I still know the property sufficiently cash flows. And as I mentioned earlier on, I'm doing a live stream this Thursday, the 24th of August, 7 p.m. Don't forget to be there. I appreciate you watching this video. Don't forget to subscribe, and I'll see you next time.